and welcome to my lecture on step 9 of the accounting cycle, and that is the post-closing trial balance. And what you see here in my image is a starting line. Okay, these girls are getting ready to start a race. Well, that's what the post-closing trial balance is. It's a starting line to start the next accounting period. In other words, what do we expect our balances, our beginning ledgers, our beginning trial balance to look like when we're ready to start the next accounting period? And we call this a post-closing trial balance because the word post means after, and closing, of course, means closing the previous period. So after closing the previous period, what does our trial balance look like to start us off for the next accounting period? So up to this point, we have done all the other steps for the entire month, and now it is time to start the new month. So this is step 9 in the accounting cycle. And the post-closing trial balance has the same format as the other trial balances that we've already done, right? We have already done the original unadjusted trial balance in step 4. And then we recorded adjusting entries. So we did an adjusted trial balance after that. And now we're on to our third type of trial balance, which is our post-closing trial balance. And this trial balance has the same format as the other trial balances, except that it includes the effects of closing entries. And as you recall from last lecture, the closing entries have the effect of returning the balances of the temporary accounts to zero and updating the balance in the retained earnings account to what it should be when we ended the previous period. So as you recall from last lecture, the temporary accounts are those accounts that we only track for a period of time, and then at the end of that period of time, they're gone, and we start over again. So those are going to be our revenues, expenses, and dividends. Okay, everything that went into the statement of retained earnings. Okay, those should all be zero. And the balance in the retained earnings account should be updated to be this amount, retained earnings end. In other words, the retained earnings at the end of the period that are going to carry forward to the next accounting period and become the retained earnings beginning for the next period. Okay, so let me show you what that looks like with our Zucker management example that we've been working on in class. Okay, so if you look here, here is the adjusted trial balance that we did together in our last class after we did the adjusting entries. And we used this adjusted trial balance to put together the financial statements, right? This was the ending numbers for the month of November, and then we communicated those numbers in a clear, easy to read format, which was the financial statements. Now, after we've done the closing entries, which, as I said, you don't need to know the closing entries, you just need to know the purpose of them and the effect of them. Well, the effect of them is this, the post-closing trial balance. Okay? Now, what I want you to notice about the post-closing trial balance is that all of the balances in the permanent accounts, which are here, are exactly the same as the adjusted trial balance. Okay? The reason being, the adjusted trial balance is the amount that we had as of November 30th at 11:59 p.m. And the post-closing trial balance represents the balance that we had as of December 1st at 12 o'clock a.m. That split second from when one month ends to the other month begins. And like I said, if we had cash at the very end of November of $26,069, I should hope that at the beginning of December, we would have that same amount. And the same holds true for all of the other permanent accounts. Okay, they stay there. They don't go away at the end of the period. But you will notice that all of the temporary accounts, which are dividends, revenues, and expenses, now are all zero on our post-closing trial balance. The reason being that they were temporary. They went away. They all related to what happened in the month of November. So when we're ready to start December, those are not relevant. Those are all now zero, so that we can go ahead and start tracking them for the month of December. Okay? So that is the first effect of the closing entries. The second effect of the closing entries is that the balance in the retained earnings account is updated. So if you look on our adjusted trial balance and you look through all of the accounts, you will not see a retained earnings account. Reason being that we didn't have any retained earnings in the month of November because the business just started in November. So they didn't have any earnings carried forward from the previous month. There was no previous month. Okay? But what you'll notice here is that we do, in the post-closing trial balance, have a retained earnings account. Now, where did this number come from? If you recall from our last class, we put together the statement of retained earnings, and this is what that statement of retained earnings looked like. Okay? We had our beginning retained earnings, which was zero, because as I said, if you look in the adjusted trial balance, there was no retained earnings balance. It was zero. Then we added in our net income. Well, we determined our net income by taking our revenues minus expenses, and we arrived at our net income of $13,690.84. And that number articulated here from the income statement to the statement of retained earnings. Then we took our dividends here from the adjusted trial balance and dropped them here in our statement of retained earnings. So the net income was the earnings that we made during the period. Our dividends were the earnings that the owners took out of the business. So what was left, the earnings that remained in the business or were retained in the business, was this $8,390.84. And that is what you will see here as retained earnings. Okay? Our retained earnings at the end of the period, and the end of the period is November 30th, 2017, now becomes our beginning retained earnings to start out the month of December. So essentially what happened is we took all of these temporary accounts, dividends, revenues, and expenses that we had in November. We condensed them here into the retained earnings amount, and that retained earnings amount is there. So it's not to say that these temporary accounts completely went away. They didn't necessarily go away. They just are moved to a different account. They are moved, condensed into retained earnings. So now this number here holds all of these temporary accounts. So we don't need them anymore. They're all in there. Okay? So to recap quickly, the main differences between the adjusted trial balance, that was our end of November numbers that we used for the financial statements, and our post-closing trial balance, which is our numbers to start out the new month of December, are that the temporary accounts are zero and the retained earnings balance is updated now to reflect what we put in our statement of retained earnings. Okay. So now that we have done our post-closing trial balance, guess what? This is, like I said, an accounting cycle. That means we do it over and over and over and over again every month. So now we are ready to start the accounting cycle again by analyzing transactions, posting the journal entries, and so on and so forth until we are done with the month of December and ready to start the new year of January. So thank you so much for watching this video. I hope it was helpful for you in explaining step 9 of the accounting cycle, the post-closing trial balance. If you have any questions, please make sure that you take a look at the reading and look at the reading guide for the most important terms and concepts you need to know about this. And if you have any other questions, please contact me to let me know and I will try to help you further. Thanks so much.